far as the defense space, there was a big merger announcement last week between United Technologies and Raytheon. Right after the merger, these two companies, instead of being up, actually dropped 5%. The reason for that was investors do not like this deal. For us, being value managers, it almost forces us to look at these companies now. The reason for that is because after that first knee-jerk reaction, which was negative, United Technologies at this point sells at about 15 and a half times earnings. Raytheon at this point sells even cheaper, about 15 times earnings, which means if we give these two companies a market multiple, 17 times earnings, and the expected earnings for 2019 for United Technologies is close to $8 a share, and today the stock still trades at about $124 a share. If we give a market multiple to Raytheon of 17 times earnings, at their expected earnings for the year, which is close to $12 a share, Raytheon should be selling today at about $200 a share, and yet they are trading in the marketplace at about $178 a share. Why the investors don't like the deal? The reason is, as far as United Technologies, they worked very hard to make their business model very simplistic in nature. United Technologies, a part of their conglomerate, they have two other units, Otis, which is the largest elevator manufacturer, and the Carrier, which is the largest industrialized air conditioning and heating unit. The path they took prior to that merger announcement was they will spin these two units, therefore creating a lot more simplicity in their structure and unleashing what has a lot of value and unappreciated value, and that is their aerospace unit. So investors were expecting to see, because of that spin-off, about 40% upside in the stock, and they are thinking that because of that new merger announcement, that will not come to fruition. And the Raytheon guys don't like the deal because they didn't get any premium sell offer for their shares. And therefore, the entire deal right now is in limbo. So why do we like the company? For two reasons. Assuming that this deal will not come through, these companies most likely will trade back to market multiple, thereby will give us an upside for United Technologies and Raytheon. And if the deal does go through, they are still one of the cheapest, if not the cheapest, aerospace play in the industry. Either way, we are almost forced to look at these two companies because they are just inexpensive at this point. Another way to look at valuations is to break down the deal proposal. The deal is structured in a way that the United Technology shareholders will get 57% of the entire company, and Raytheon will get the remainder, which is 43% of the entire deal. Post-spin-off valuation is that each share of United Technologies will be given to Raytheon at a ratio of 2.33 shares to 1. Add to it also Otis and Carrier, which is worth about $59 a share, and that is the upside. The upside can be anywhere from $135 a share to close to $200 a share. The new company will have north of $80 billion in sales. The new company will assume about $24 billion in debt on the books that United Technologies has, and only $2 billion in debt that Raytheon has, but the earnings power for these two companies is substantial. United Technologies bought recently Rockwell Collins, and they have their unit Pratt & Whitney, where they manufacture engines mostly for Airbus airplanes, which are competing against the Boeing MAX 737. There is a lot of demand, a lot of backlog in this industry. So if you combine the aerospace capabilities of Raytheon with Pratt and Whitney and Rockwell Collins, you get one of the top-notch aerospace companies in the industry, trading at about 15 times earnings, which looks to me pretty interesting. Another topic I wanted to talk to you guys is the banking sector. We speak time and time again about interest rates, and the idea is that we might see a cut in interest rates of 25 basis points in July, an additional 25 basis points cut in September, and one more maybe in December. So the market right now is pricing about 75 basis points an interest rate cut. Assuming that some of it is going to come to fruition, we should expect that that might unleash additional growth into the economy, thereby the 10-year treasury should sell off and interest rates can start moving even higher. If rates go up, then banks can do even better because they still borrow money at a very low interest rate on the short end and re-lend that money on the longer end at a nice spread. There are two big news that are coming this month about the banking sector. One is the stress test results. After the collapse of the real estate market and the financial disaster of 2008 are going every year through stress tests where they are put under very rigorous bad economic conditions of very high unemployment and a total catastrophe in the marketplace in the event we're going to get another recession. And when they pass these stress tests, it lets them, if they choose, raise dividends and buy back more shares. Another comprehensive test that these banks have to go through that will come a week later is a comprehensive capital analysis and review of the processes that these banks have in place to use efficiently their capital for buying back shares, to pay dividends, and do other things to grow their business. Assuming that the banks in the universe, the big money centers, will pass these tests with flying colors, they will be in a position to raise dividends. And if they do that, we should be ahead of the curve looking at these companies. And if we don't have enough investments in them, we might consider to putting more money to work, especially realizing that there is a possibility that the 10-year treasury bond is going to start paying more in interests, and banks will be able to profit from that. So some of the banks that come to mind that their dividend payout ratio is below the average for the banking sector, which normally is at about 40%, are companies such as Citigroup and Bank of America. Citigroup in particular sells at 1 times their tangible equity book value, which is considered, on a comparison with other banks, inexpensive. Citigroup pays at this point about 2.7% in dividend. Bank of America pays about 2.1% in dividends. So that sector that sells at about 10 times earnings, way below the market multiples of 17, should look quite attractive for value managers.
Okay, August 28, 2017 was the day that C-suite members across every industry sat up and paid attention. That was the day that Amazon acquired Whole Foods. Now, why would the CEO of, say State Farm be concerned when maybe Kroger CEO should be concerned? Well, this is the reason that big tech established that they could roll out their tech superiority to any vertical market. We saw that this could affect insurance, prescription drugs. We're seeing a lot of the big tech giants jump into these spaces and again apply that technical framework without having the competitive advantage in that vertical market. Most recently, Facebook, they displayed this ability to apply their technical expertise to the cryptocurrency market. And they have a project codenamed Libra, has some of the big payment giants behind them. These are companies including MasterCard, Visa, Stripe, eBay, PayPal, Coinbase. And if you know, I mentioned one of the actual cryptocurrency giants in there, Coinbase, who specializes in blockchain. So it's really a boon to cryptocurrency in itself. Some of the shortcomings of Bitcoin is stability, security. It has low inflation, global acceptance, and fungibility. Okay, and this will be provided because Facebook, again, has over 2.5 billion users. They have backing from some of the biggest companies in the world, which is one of the prerequisites of something like blockchain, which really needs adoption by more than one entity. You really need, with a public ledger, more of those companies involved than just one. And this really has to do with the ubiquitous nature of cryptocurrency and how it's adopted. So this is very interesting from our perspective and something we'll continue to watch with Facebook.
In anticipation of the Fed's meeting upcoming this week, I was reading a little bit over the weekend and kind of consistent with what we've talked about. The futures market predicted only a 26% chance that we would have a decrease in interest rates this week, and they're expecting 85% chance that we'll have one by July, and then another 0.25% drop coming September. So looking at the 10-year over the last week, the 10-year did go up to 2.15 and then closed at Friday at 2.09, and it's currently at 2.08. It's down a little bit. It still remains at a 20-month low since September of 2017. The 2-year versus the 10-year has still not inverted. That spread has stayed at about 25 basis points. Short-term rates, the 1 month to the 3 month, versus the 10-year, that does remain inverted, but that gap is narrowed to about 12 basis points. And the 2 versus the 3-year, that has remained consistent at about 5 basis points, and it remains inverted.
So something interesting I read over the weekend, and we touched on this last week, how Main Street and Wall Street have this sort of inverse relationship. On Friday, as we all know, stocks slipped, but we actually got positive economic data. We got retail sales were up 0.5% in May from April. Overall sales rose 0.3% in April, as opposed to an analyst estimate of a 0.2% decline. So I thought that was just an interesting thing to point out, because it did reduce the likelihood, actually, those same futures traders that Richard just mentioned.
Hello everybody, and thank you for watching our videos. I'm Amit Stavinsky, the Managing Director of Tamar Securities and its affiliates, 911 Financial Services and Firefighters United. As always, if you like the content, please sign up to our YouTube channel to get our videos and content in a timely manner. The highlight of the week is that financial markets, although not necessarily inexpensive at this point, selling at 17 times earnings, they are still, in our view, not overextended. It is important, however, to look for value opportunities whereby we can find individual investments that still sell at discounts to the market multiple and yet present upside opportunities.